The following podcast by Fusion Family Wealth, LLC, Fusion, is intended for general information purposes only. No portion of the podcast serves as the receipt of or as a substitute for personalized investment advice from Fusion or any other investment professional of your choosing. Please see additional important disclosure at the end of this podcast. A copy of Fusion's current written disclosure brochure discussing our advisory services and fees is available upon request or at www.fusionfamilywealth.com.
Thanks for tuning in to another episode of the Crazy Wealthy Podcast, Fix It Friday edition. Today I'm going to talk about two things. First is I'm going to distill a counterintuitive way to think about risk, returns, and volatility. And the second thing I'm going to do is explain how reframing risk, return, and volatility, the way I'm going to describe, is going to help you to become better decision makers in real life when it relates to money and uncertainty, and when they collide together, those two things.
Welcome to the Crazy Wealthy Podcast with your host, Jonathan Blau. Whether you're just starting out or are an experienced investor, join Jonathan as he seeks to illuminate and demystify the complexities of making consistently rational financial decisions under conditions of uncertainty. He'll chat with professionals from the advice world, entrepreneurs, executives, and more to share fresh perspectives on making sound decisions that maximize your wealth. And now, here's your host.
First thing I want to talk about is defining volatility. A lot of people think volatility means straight down in a hurry, and it doesn't mean anything like that. Volatility is simply the rate and the magnitude of price movements in either direction, up or down, in the short term. It's daily zigs and zags in the prices, in this case, of investments in general, and today I'm going to be talking about investments in stocks in particular. So this is not the same thing as risk in the long run, and it's not a direct measure of the quality or the durability of the underlying businesses that we own as stockholders of corporations. Volatility tells us how bouncy the price is, not how solid the underlying business fundamentals are. And it's important to always keep those two things in our minds separated so that we can become better investors. A short-term drop in prices does not mean that a business is failing. It simply often reflects the current mood of the marketplace, which can be reacting to anything from current events to politics to real problems like COVID, for example. And all of a sudden, from February 20 to March 20, when the economy globally started shutting down, the prices of great companies, the S&P 500 companies, declined by 34% in 1 month. So most rational people, if they ask themselves a question, do I really believe that the long-term enduring values of companies like Apple Computer and Merck, the drug maker, or Nike have disappeared? Of course not. These were just temporary declines in the prices of the stocks of those companies. And ironically, when the prices of the stocks is declining, the value of the companies becomes increasing directly in proportion to how much the stock price is declining. In other words, if we're paying a lower and lower price to own a percentage of these companies, we're getting more and more value as we pay lower prices. So the irony of how we process volatility is that it's actually not our foe, but often our friend for many reasons. So if volatility is not the same thing as risk in the long run, why do we often treat it, or why do investors often treat it as it is? Because it's tangible. We can see it. We can measure it. We can feel it in our guts when the market moves. It causes us to mistake the noise for the signal. And often we abandon our plans in response to mistaking the noise for the signal. What I call the noise is anything from pandemics, recessions, bear markets, Democrats or Republicans, whichever the person is pro or con, wars, peace, inflation going up, interest rates going up, etc. That's all noise. What the signal is always that causes long-term prices to increase is earnings. And earnings of great businesses continue to grow. For the last 100 years, they've grown dramatically and continue to do so. And the reason they do that is CEOs, executives of public companies have a fiduciary responsibility to maximize shareholder value. So when they're faced with crises, They respond to the crises rationally. They may reduce the workforce. They may pay down debt. But there's certainly one of the things they're not going to do is continue with any activities that they see continuing to lose money. They can abandon and jettison those activities right away. That's their fiduciary duty. And they come out of the crises stronger and more profitable ultimately. So short-term horizons can tempt us to confuse what fluctuates with what matters. Nassim Taleb put it best. He said, when we focus on short-term volatility, we are observing the variability, the up and down movements temporarily in the portfolio, its zigs and its zags, but not the returns. We're not observing the returns. We confuse the zigs and zags in prices with the actual growth story of the business and the investment in the business long term. So the industry siren call, the big Wall Street firms in general, but the financial advice industry siren call, tempts us to seek out safety in principal protection. Protecting, if we have $1 million, that's what we need to do, is protect that principal, and not just from disappearing, from even fluctuating. So their goal is to lure us with the promise of what they call smooth returns, or limited volatility, limited up and down. They sell us safety, rather, as the absence of volatility. They pitch products called principal protected and low volatility. There's a critical misalignment here to explore. If you mistake volatility for risk, you may opt out or into strategies that lower expected long-run returns and actually pay for advice that causes and even accelerates running out of money. So let's explore how this happens and how should we redefine or reframe risk, return, and volatility. So instead of thinking about risk as volatility, and instead of defining risk and safety in terms of the need to protect our principal, the $1 million, from temporarily fluctuating, instead of being concerned with the number of dollars changing from time to time in the portfolio due to market corrections and things of that nature, redefine risk and safety not in terms of protecting principal from fluctuating, but from protecting purchasing power from disappearing. So while the whole world is taught to worry about fluctuation in the number of dollars, they're given strategies, for example, bonds, to go into the portfolio to solve the wrong problem, which is volatility. I call that the illusory risk. And when we put more bonds in the portfolio to solve an imaginary problem, volatility, we actually are feeding the real problem, which is the disappearance of our purchasing power. So for example, every $1 million that I put today in a bond to reduce movement temporarily in the portfolio from time to time, every $1 million for the next 10 years, 20 years, 30 years, I keep rolling the proceeds when that bond matures into a new bond. At the end of 30 years, I can still only have the same $1 million. But at the end of 30 years, I need almost $3 million to buy what $1 million bought. What happened along the way is I was forced to unwind the $1 million principal and ran out of money because nothing was protecting my money against the 3% increase in the cost of living every year. Bonds were actually, if inflation is the disease of money, bonds are the carrier of the disease, not the cure of it, because they freeze your money in the face of a 3% plus compound annual grinding away at its value, which is what we call inflation. So why do we actually behave in such a way that we react to this volatility as if it's going to destroy us if we don't control it? So there's a few actually behaviors that I want to share with you. One is, it's a cultural behavior. We actually process most economic and financial inputs in a way that's called counter-cyclically. What it means is the demand for goods and services is counter to the price of them. So if the price of something goes up and is increasing rapidly, we're actually going to try to shun it, replace it with something whose price is not going up as rapidly, or simply delay the purchase until prices come back into more reasonable prices that we can accept. And conversely, if the prices of goods and services that we want are declining, the demand is counter. It's increasing. We love a sale, right? That's how human nature works. But what's fascinating is that we respond counter-cyclically to every economic and financial input except one. and that's the price of investments, particularly the price of stocks. When the price of stocks is high and rising, as it was during the dot-com bubble in the late 90s, human nature thinks somehow that the risk of buying these stocks at higher prices is lower than the risk of having bought them at lower prices. They also think that the future return, if we pay higher prices for these companies, is somehow be greater than if we paid lower prices years earlier. Conversely, when great companies go on sale, when the stock prices are declining, so we're buying more and more shares for less and less money, human nature thinks the risk of buying these companies at lower prices has increased and is increasing, and that the future return on the companies that we're investing in at lower prices, buying more shares for less money, somehow will be a lesser return than if we paid higher prices. And what I always teach everybody who interviews us to help them with their money is reality isn't just different than what human nature thinks. It's opposed to it. It's the opposite. Higher prices for stocks or anything else means lesser returns than if we paid lower prices. Lower prices being paid for stocks means higher returns and less risk. And that's the first behavioral flaw that influences our reaction to volatility. The second thing is called loss aversion bias. We actually dislike the pain of a loss, feel the pain of a loss 2 to 2.5 times more than we feel the pleasure of an equivalent gain as pleasurable. And so human nature seeks not to maximize long-term best returns or best interest. It seeks to minimize the chance of short-term loss because that's what's most painful to us. And in seeking to do that, we seek out investments that minimize short-term loss. Cash, bonds. Those are the same things that minimize the ability to overcome the ravages of inflation and to grow our money. So that's loss aversion bias. The third thing is related to it. At a certain level of loss, the part of our brain that deals with fight or flight, the reptilian brain, called the amygdala, the organs, 2 little walnut-shaped organs at the base of our brain, they still process fear the same way they did 50,000 years ago when our primary threats were physical, not dealing with the vagaries of the financial markets, right? And it's never developed to modern times to allow us to do that. We're programmed to do the opposite of what's needed to deal with the capital markets. So, for example, when there's a bear in the woods going to kill our ancestors, this was a phenomenal thing. The loss aversion bias, it said and the amygdala shooting off the signal, just run. That's it. You don't think about it. Well, today, the problem is the amygdala doesn't distinguish between a bear in the woods, a permanent threat of death, and a bear market, a decline of 20% or more in the prices of the companies we own, which is a temporary threat. It doesn't distinguish between the two. And as soon as the markets, what I found, go down more than 20 or 25%, something gets triggered where the ability for a human being to distinguish between temporary decline and permanent loss is so blurred that they can no longer distinguish, and that's when they're gone. That's when they abandon the portfolio. So in summary, how do we deal with the issue of mistaking volatility for something that's meaningful as it relates to being able to succeed in our long-term objectives? Meaning, how do we fight the thought that I need to control volatility to succeed? It's actually not true at all. What we need to do is understand that there are 2 types of money. There's wealth, whose natural function is to accrete and to grow over time. And there's the other kind of money that runs out. Many advisors in the industry that I've met are actually money that runs out managers because they're foisting on the clients the idea that bonds are going to protect you from volatility. And when they're giving those bonds, what they're doing is they're ensuring that whatever extra money is in bonds for the illusory risk of volatility is killing the value of every dollar every day and every year to the tune of at least 3%. So what we need to do is just reframe. Investments that lead to the protection and growth of our purchasing power are safe. Real assets, companies, by virtue of stock ownership, those are safe. Investments that lead to the freezing and even destruction of our purchasing power, those are risky. Bonds and other investments like annuities that freeze our purchasing power in the face of inflation are risky. Now think about what I just said. Countercultural, counterintuitive. Stocks are safe, bonds are risky. I'll leave you with that thought, and thanks again for tuning into another episode of Fix It Friday.
Thank you for tuning in to another episode of the Crazy Wealthy Podcast. For more insights, resources, and to sign up for our newsletter, visit crazywealthypodcast.com. Until then, stay crazy wealthy.
The previous podcast by Fusion Family Wealth, LLC, Fusion, was intended for general information purposes only. No portion of the podcast serves as the receipt of or as a substitute for personalized investment advice from Fusion or any other investment professional of your choosing. Different types of investments involve varying degrees of risk, and it should not be assumed that future performance of any specific investment or investment strategy, or any non-investment related or planning services, discussion, or content will be profitable, be suitable for your portfolio or individual situation. Neither Fusion's investment advisor registration status, nor any amount of prior experience or success should be construed that a certain level of results or satisfaction will be achieved if Fusion is engaged or continues to be engaged to provide investment advisory services. Fusion is neither a law firm nor accounting firm, and no portion of its services should be construed as legal or accounting advice. No portion of the video content should be construed by a client or prospective client as a guarantee that he or she will experience a certain level of results if Fusion is engaged or continues to be engaged to provide investment advisory services. A copy of Fusion's current written disclosure brochure discussing our advisory services and fees is available upon request or at www.fusionfamilywealth.com.